So in this chapter, we'll be discussing about instruments of credit control. So at various sections before, we spoke that RBI uses various tools to control the money supply in the economy and the level of credit, the level of borrowings. So those instruments are broadly classified as general and selective instruments. Okay. So general instruments are like CRR, SLR, we have discussed earlier, bank rate, open market operations. All these are general instruments of credit control. So bank rate is currently 6.25%. It's usually raised when there is an inflationary situation. This earlier RBI used to rely a lot on bank rate to control the economy, but that has reduced a lot. Okay. Now RBI has been emphasizing more on repo rate and reverse repo rate rather than bank rate. Okay. Then there's something called open market operations, which also we discussed in the previous chapter. This refers to purchase and sale of securities. So we have seen how RBI does this by repo rate and reverse repo rate. RBI buys and sell government securities, treasury bills and other approved securities. So all these are CRR, SLR, bank rate, open market operations are general instruments of credit control. Then there is something called selective instruments of credit control. These are restrictive measures which are targeted at regulating the flow of credit to specific sectors. Say for example, commercial banks cannot lend to traders for speculative hoarding of commodities by traders. Okay, so this is a selective instrument of credit control. So whenever the measures are targeted at a particular sector, not for the entire economy, only for a particular sector, it's known as selective instruments of credit control. So in interviews, they'll ask you what are the two types of instruments of credit control and what is the current bank rate.